Welcome, everybody, to the Investors Podcast 2.0 Wealth Mindset, where we dive into the minds of the successful real estate entrepreneur to uncover the tips and tricks that have allowed them to keep moving forward. I am your host, Scott Bauer, and I'm excited that you're here with us. Welcome back, everybody, to the Invest This Podcast. I am your host, Scott Bauer, and today, guess what we're talking about? We're talking about notes with the note guy, Nick Legamaro. I'm excited. Nick, thanks for being here today. Notes have been the buzzword, right? The buzzword around the marketplace because they're a powerful thing. They're a powerful thing that allow you to get cash today potentially and have long-term cash flow. Your wealth creation just starts there. It's a big deal. It's a big deal. And, you know, I like having you on the show because you bring a lot of experience to the table that really can help you, the listener out there that's listening to this, maybe get over some obstacles that you're struggling with today, and or maybe just get some insight from an experienced investor that knows what they're doing. So, Nick, thanks for being here, man. How are you?
I'm great, Scott. Thanks for having me on.
Super pumped
excited to jump into this.
Prior to this call, everybody, you know, Nick and I just started getting off on a tangent. I said, hey, hold on, we got to get on the call because this is what happens when you get some investors in the same room. You just start talking for days, and that's exactly what happens. So, Nick, let's get into this. Why don't you give the listeners more about your background?
Yes. So I'm actually in the Dallas-Fort Worth market, but I do deals all over the United States. Matter of fact, I just bought up a note portfolio with about 70 assets in 23 states. So you just don't really know what you're going to come across. But my core business, which I started a company back in 2010, it still is called Rylex Capital. It started out as basically a buy, fix, sell, create the note, sell the note, repeat, right? So instead of it being, a fix and flip for transactional cash, it was add the note creation on the back end of it for seller financing and sell it on terms, cash out of the deal, recapitalize the business, and then go on and do it again. So there's a lot of things I know now today that I didn't necessarily know, 10 years ago or 8 years ago, however long it's been. And hopefully we'll be able to share some of those successes, and I don't want to call them necessarily failures, but learning experiences, so that anybody else that might want to get involved in notes can understand some of the, notes it's not difficult. It's just complex. If you look at like a fix and flip model, you buy it, you fix it, you sell it, and you move on, right? The moving parts in that, and you go into a wholesale model, there's just not that much going on. But when you start dealing into the one more step of that and doing seller financing and start getting into compliance and Dodd-Frank and SAFE Act and RMLOs and underwriting and, all that stuff, you just got to understand what you're doing. I'm going to say it right now. I'm a lot earlier into the call than I normally am. I'm not an accountant, I'm not a financial advisor, nor am I an attorney. So I'm just going to speak from what I know and just try to be as transparent as possible. And, if anybody in Texas is not, California or Ohio or, any of the other states in the continental United States that you may be doing business in. So
every state has their own rules.
Yeah, figure them out. But I do know this is that seller financing as a investment strategy is extremely lucrative and I tell you what, I don't know of anything better, honestly. And we can debate, buying and holding apartment buildings or rental properties or whatever. But I always go back to this. There's a reason why banks are in the banking business. There's a reason why the biggest buildings and the most profitable companies are banks. You go into any downtown, the biggest buildings are the banks. Banks don't own real estate. They control real estate, and they control real estate by lending money. And when they lend money, they get paid in an amortized fashion. And if anybody understands how amortization works, you can see real quick why there's a huge advantage to being a bank. And that's basically what we created and what I was able to do over time is figure out how to be the bank. I don't really want to own real estate. I want to control it, and I can control that through owning the property by owning the note and collateralizing the debt with the property assets.
So before you even got into that, though, I mean, you don't just go. You didn't go from wake up one day and then you're like, you know what, I'm going to be the bank. You know, you had to go through a learning experience to get your mind wrapped around what this meant to be the bank. Because I can tell you, I know a lot of real estate investors that do a lot of business that don't know what it means to be the bank. I mean, they honestly, they still are in the dark on what that means. So, how was it that you became into that? Was there a mentor that you had? Was there a, you know?
Yeah, that's a great question, and we'll maybe get into the educational side later on in the call if we have time. But I got started in real estate in the early 2000s. I've been doing this for almost 20 years, and then the biggest advantage that I have over probably 90% of your listeners is that I was doing business pre 2008. There's a lot, majority of the investors in the real estate business today got into it after 2008. You look at all the influencers in the real estate market, all the people that are doing podcasts, all the people that are educating. They weren't very, very, very few of them were doing anything of any consistency back before 2008 are doing it now. So there's been a huge, I don't want to say it's been a great ride, but now I was very fortunate to get out of the crash as I experienced it fairly unscathed. A lot of people never came back. A lot of bankruptcy, a lot of people never came back. So I went from 01 to 08 doing, boy, I tell you what, just doing everything wrong, for lack of a better word, because I didn't know what I didn't know. And I say that a lot. And that's probably the most important thing that I would say is you don't know what you don't know. And what I mean by that is you think you know, but you don't really know. And that's why it's so important to listen to podcasts like this and go to 3-day REI events and, seek education in masterminds. I know you're in masterminds. I'm in masterminds. I spend $50,000-$60,000 in masterminds a year just because it's so important to be educated and learn from other people, from both their positive experiences as well as some of their failures. So that would be my biggest thing. It's probably going to come up again later on, but I didn't have that early on. And there was no REI clubs back in 2002. There was no training and education available that you could go spend 5-10 grand on to learn how to be, there wasn't no wholesaler in the box, training, as you know. So that's the biggest challenge that I have. But so after 08, I took off about 2 years because, at that time we didn't know how long this was going to go down. And I came back in 2010. I really wanted to get back into real estate. I knew that was the key to building wealth, generating wealth, and getting cash flow versus a traditional 9-to-5 W-2 job. And so I started going through, at that point in time, there was a lot of information coming out. There were a lot of educators, influencers, and stuff that understood that and done a lot of deals. And so one of the things I started going, what made sense to me at that point in time, I didn't have a lot of money, was wholesaling. Because I did know that no matter if you wanted to be a fix and flipper, or if you wanted to be a lender, or you wanted to be a buy and holder or seller finance guy, it all starts with the deal. And the deal has to start with being able to negotiate direct with the seller. And that's what wholesaling is truly about. Right. So I went through, so when I got back into this, leave everything out between 2008 because it really had no impact on where I am, what I've been doing the last 10 years. I went in and I did the typical thing. I sent out yellow letters and postcards, and I didn't have a lot of cash, and I didn't know how to really even do anything, to be quite honest with you. I knew that I didn't want to do what I did before, which was taking it down. So I thought I was going to have to buy these things for cash. I didn't know about assignments. I didn't know the ability to do that. My thought I was going to be basically take it down for cash and turn around and sell it. And I sent out some yellow postcards, and I kept the price point extremely low. Back then, I was sending stuff probably in the $20,000 to $80,000 range. So you can imagine, that's probably double that today. So there's just not a lot of inventory in that. So I get a call, and the lady goes, "Hey, I have a property that I'm looking to sell. You got your postcard." And this is like literally the first wholesale deal that I ever had experience with this in this way. And she goes, I want 20. I asked her all the wrong questions. How much do you want? She goes, I want $25,000 for it. She goes, I'm retiring from General Motors. I'm moving to California. I don't live in a house anymore. There's renters in it. It's a little 2-bedroom, 1 bath, 700 square foot, POS that, that's exactly what it was probably worth. So I went out to the house. I drove out there. She goes, you can't go inside. It's got tenants in it. I go, no problem. I'm going to just go drive and look the neighborhood. So I went and I get out there and I go, oh, I guess that's what a $25,000 house looks like, right? And so I have no idea if this is a good deal or a bad deal. I just don't know. So I'm driving down the street. I get to the corner and there's a sign called, it says Vende Casa. Well, I know enough Spanish to be dangerous. So I call the number and I go, I do know this, the bandit signs, if there's a sign to buy, that means they probably sell. And if they're selling, they probably buy. So I call the number and she goes, hola. And I go, do you speak English? And I go, she goes, yes. I go, hey, I saw your sign. I got this house. I don't even remember what street it was on. That I'm looking to sell. Would you be interested in buying it? And she was actually representing other sellers. Didn't know that at the time. And she goes, I don't know. I gave her the address. She goes, let me call you back. So I'm literally driving back to my house and I get the phone rings and she goes, hey, I got buyers outside your house. Oh, she goes, how much do you want for the house? I go, I want $35,000. She goes, I'll call you back. I go, whatever. I didn't even know what that meant. So so I literally get a phone call 30 minutes later and she goes, hey, I got buyers outside the house. I go, oh, crap. There's tenants inside. I go, don't knock on the door. They can't go inside. It's occupied. Can't disturb tenants. She goes, they're not going to do that. They're just walking around the outside. I got a big picture of this too. She goes, they said that this is literally less than an hour after I don't even have this house under contract yet, right? She goes, they said they'll give you $32,000 because they can't get inside. I go, okay. And I go, how much did you want for it? She goes, I want $1,500. So I did the math in my head real quick. 32 less 15 and 25. Okay, make about $5,000, whatever. I go, okay, that's fine. I'll meet you tomorrow for a contract. I think that's what I ended up doing. I didn't have it under contract yet. So I went back, got it under contract. I go, okay. So long story short, we got the deal done, made it $4 or $5,000, whatever the net was. And then I get another call about 2 days later. And it's a little bit different of a house, a little bit nicer. Still, the lady owed about $22,000 on it. She wanted to just be out of it. She had moved or divorced or something. And the value was about $50,000. So I called Lydia back on the phone and go, hey, Lydia, I got another house. And, but it's a little bit nicer. I said, if I can get $25,000 down payment, I'll finance the rest. I go, do you have a buyer? Do you think they would put $25,000 down and I'll finance the rest? Because my thought was, well, if I get $25,000 cash, I can take that $25,000 and pay her to $2,000, $1,500, pay off the underlying debt, and then I wouldn't make any cash on the deal, but I would basically be left holding a note. And I knew, well, there was no risk in it because I'd be out of the deal, and if they'd stop paying the note, I wasn't going to be out any cash on the deal. So ended up getting that deal done. I wrote this awesome note for 5% interest for like 5 years, and it was a horrible note I wrote actually, but it's been paid off and we did the deal. So I'm talking to Lydia and I go, Lydia, let me ask you a question. I go, you just had a buyer in less than a week with $30,000 cash, another one with $25,000 cash. I go, how many buyers do you have that have cash? Because I don't know them. I don't even have $25,000 cash at the time. And she gets out this like spiral notebook, and it was just page after page after page of name, cash, $10,000, $15,000, $80,000 cash. And I go, okay, now I'm starting to see something. I go, let me ask you a question. If I had nicer houses like that were worth $80,000 or $90,000 at the time, could we still get $10,000 or $15,000 or $20,000 down payment if I could finance the rest of the deal? And she goes, absolutely. And so that's sort of how I established in the, writing notes, and 600 notes later, here we are today. So, but there's a lot of stuff that obviously took place during that time period. Because go ahead.
Well, I mean, because for the general person, they wouldn't know just to go write a note, right? They wouldn't say, okay, well,
Right.
but where, how was that you figured that out? Or where did you learn that? Where did you see it? When were you like, because I mean, it doesn't just click, right? Like, oh,
No,
well,
well,
I mean,
you know, it's a great question. I don't know. The only thing I can go back to, because I know a lot now, and I don't, but it was all after the fact. Like Mitch Stevens, a good friend of mine, him and Mike down in San Antonio, they write hundreds of seller financing deals. So what had happened is that it sort of just evolved. I knew that I was on to something. I didn't know that I didn't know that I could do all deals with being cash neutral, basically, which was what that second deal was. I mean, how realistic is it to get $25,000 down on a $50,000 house?
right.
And right now, not realistic.
Yeah.
But one of my very first lenders that I took this to, I knew I could sell the notes because I'd seen stuff with note. You know, I'm in Dallas. Eddie Speed's in Dallas. You know, he has Colonial Funding, so I know you know Eddie as well. Didn't really understand any of that stuff even at that time. So one of my lenders that that helped me out in the very beginning, that probably was the lender on maybe my first 5 or 6 deals, is a guy named John Montero. And John Montero, who now became a partner of mine at Rylex when we sold our company to the bank. Him and I basically dissolved Rylex as we know it. He's off doing, you know, multifamily and syndication and stuff. But we still talk, you know, a couple times a week. And he goes, if I'm able to manage the financial aspect of it, basically the funding of the capital, finding the capital and funding the deals on the acquisition side, and then liquidating and dispositioning the notes, do you think you can find these properties and find these buyers? And of course, the answer was yes. And so we partnered and together and created, you know, this company where we started basically buying the property through a wholesale model. You know, either buying them direct from seller or more than likely through a wholesaler MLS. We'd fix them, and we'd go create the note. I mean, we'd go find a buyer that needed financing. We'd create the note, and we would sell the note, and we'd sell the note at a discount. So it was, in the very beginning, it was 100% transactional. So all we were doing, the only difference between doing it as a wholesale deal, I mean, a fix and flip deal, and the seller financing, we were adding that extra layer of the financing on, because when we ran the model, I could fix and flip it for say 15,000 and just sell it retail, or I could fix and flip it, create the financing, and sell the note and make 20,000. So we were actually able to make more money, but more importantly, we could sell them faster because the price at points that we were dealing in, there wasn't a lot of retail buyers that could go down to the bank and get qualifying for a note. There wasn't a lot of people that could go down to Wells Fargo, Citi, Chase, or wherever and go get financing on a $100,000 property. It just didn't exist. And if they could get financing, they weren't buying these properties. They were going to the next level of house to buy, newer, better location, better schools, or whatever. So that's basically how it started. And then as time goes on, you know, try to really figure out how to monetize. You know, it was always about cash flow, but we couldn't never figure out in the beginning on how to get cash flow out of this model because we had underlying debt that had to be paid for, right? So, for example, if I'm going to use a $100,000 analogy.
Easy math. Yeah.
If the property's $100,000, we were probably all in that property for $75,000. Okay. So maybe a little less. Let's use 75,000. So we would write the note for $100,000. We'd get probably 10 to 15% down. Let's call it 10. So I get $10,000 cash, and we'd write a note for $90,000. And then we take that $90,000 note, and I would sell it for, say, $82,000. So now so what's the cash on the deal on that? It's $10,000 from the down payment of the cash, right? Plus, I sold it for 82 minus 75 is 7, because I got to pay off the underlying debt. So I'm completely out of the deal. I made 10 plus 7 made $17,000. So $17,000 on a $100,000 sale, and doing that, and we could do that in literally 60 days. So that was the velocity of it. So I could take that same capital stack, and I could turn that same capital. So on $100,000, I can make $17,000, 17%, but I can do that probably 4 to 5 times a year with that same $100,000, right? So what's the return on that investment? It's pretty damn high.
Still
Probably
really transactional though, right? I mean, at
it
that
was
point,
all transaction. That was the problem. So like we were talking about earlier, so I'm making 50, 60% return
yeah,
annually based on the only using the same capital because I can keep repurposing the money.
yeah,
Or I could just, or how can I, the question was, how can I keep some of it? Because we knew we have the cost basis. And this is where it gets a little tricky because um, it's not a very good business model to borrow short and lend long, right? I mean, all the lending available out there, like the hard money and it's all short-term cash, right? 12, maybe 18 months, unless you get in the private money. But regardless of where the lender's coming from, I'm writing 30-year term notes, right? So my borrower that I'm selling to, we're writing them a 30-year term, even though the rate's high. So they're paying us over a 30-year term, but I have to go borrow on a shorter time frame. That's not a good model. I mean, it can be a dangerous model because if you don't have the way to exit out of it, so we could never solve that problem. And then as we go on hundreds of notes in, and there's stuff called like hypothecation, which is basically using the note as collateral and the bank's lending on that note. I don't want to get into too much detail on that, but it's very similar to going to the bank and having a buy and hold property that you want to finance long term that you're going to make into a rental. It's pretty much the same thing, except now you're using the note as collateral instead of the property, right? Because the property is somebody else.
On that? What are they?
Say again?
What are they loan as collateral on the notes? 70.
So 65 to maybe 75%. It depends. There's a lot of factors.
Yep.
They want to look at so let's just say it's 75%. My cost base is 75%. Well, then I can get all my cash out to cover the cost basis on that money. And now I'm paying 5% on $75,000, but I'm collecting 10% on, what was that, $90,000 times 100, right? So that's one way to do it. I don't write them that way. I personally, what I do now, most of my deals are much higher ratios. On a typical deal, my cost basis is still in that 75%, but I'm doing $170,000 sale prices. So what I'm doing right now is I'm writing a first and a second lien. Okay. I'm selling the first lien, which pays off all the cost basis in it. So I have zero cost basis in the deal. I might make anywhere between $8,000 and $15,000 in cash, depending on how much down payment I can get from the deal. And then on top of that, I get to keep a free and clear second lien. So that's sort of what I personally have done to sort of hybrid the model so I can get some transactional cash, but ultimately I'm looking for cash flow because that's really the key to this game is be able to get it. Even if I had $1 million and I just wanted to keep buying and buying and buying, I'm going to run out of cash at some point in time because because even though the return is great, but I can't scale it like that. So now, fast forward to 2020. So what I do now is I help. I still write and create notes. I still do the same model that I always done. I go buy portfolios or I buy notes from individuals that have created seller financing. Because here's the thing: I treat myself more as an institution than an individual. What I mean by that is, I'm looking for the long-term cash flow, where individuals that go right, they're mainly looking for the cash, the transactional side of it. Because a mom and pop, we buy notes all the time. Somebody that goes and writes a seller finance house that they have free and clear, and they write a note on it to somebody, and they get 5% or 10% down and $500 a month on a $50,000 note. There's a good chance at some point in time between now and that 15 or 30-year term that they're going to need a lump sum of cash. They're going to say, you know what? I'd rather have $25,000 today than $500 a month for the next 20 years, because people, have weddings, they need new cars, the kids go to college, whatever it is, and they don't. So we come in and buy that no differently than how you would go buy a house as a wholesaler. It's not any different when we go to buy the notes. So we buy the notes, and then we create the notes, and then we also help other people that have the opportunity that come up from either dealing with motivated sellers that cash, maybe they need more cash, maybe they don't want cash. Not all sellers want cash, contrary to popular belief. Do a lot of deals where we take them down subject to the existing note, or take them down where we get terms from the seller, because I mean, almost 40, at least 35% of all houses in the United States are owned free and clear.
Yeah.
So,
Yeah.
when you find, especially if you go east of the Mississippi, so anybody that does deals on the eastern half of the United States, there's so many opportunities where you can go pay a little bit more to that seller by getting favorable terms and rates that allow you to go and create these kind of scenarios.
So let me ask you this, because I know that we've talked about uh, kind of your career, and one of the big struggles that you had, or one of the big things that we talked about before, with regards to when you figured out that you're able to stay in a deal. You went from being very transactional in the note buying and selling business to realizing that, oh wait, I've done a shit ton of transactions now that I could have stayed in the deal, right? Because you could have created a second and stayed in the deal, still collecting cash flow, like you talked about just a few minutes ago, where you're able to collect cash today on whatever the down payment was, and then you're also able to stay in a deal on a second in a second position and still collect that cash flow. And like you're talking about, somebody, if one of these buyers is going to buy one of these notes from you, or going to that you're going to sell or finance to them, decides that they want to refinance or sell the property or whatever it is, you also get a big bump because you're still in the deal in second position, right?
Yeah, so I'm still protected in the second position on that as well. So first position is always better than second position, but
Right.
on the stuff I create and the way I write the notes, I'm going to be protecting the second position because I'm going to get a right of first refusal on the first. I'm still going to see the servicing on the note. I know I underwrote the borrower, or the RMLO underwrote the borrower, so I know the history of that borrower at the time that I wrote it. I know the property, because what we've always done, and I'm not saying this is the right way to do it. I'm actually starting to change some of the philosophy on it. When I used to do the buy, fix, sell, write the note, sell it, do it, our buyer was always we were always doing that with the institutional buyer in mind. Like, we were going to take it and sell it to a financial institution, a hedge fund that was going to want to see a nice stack file. When we were done creating this file of this borrower and this property, it was just as good as anything that you would find from Wells Fargo, Chase, Citi, any of those banks. The file looked identical. The only difference that we have as a small cap lender, which is, I don't know what they just changed it. I think it's like 10, like $100 million or 500 deals a year. It's something. It's a big number. The only thing that we really have to do as a small cap lender is we have to be able to prove that the borrower has the financial capacity to make that payment, right? So we write the credit score is not an issue. Well, we consider it, but it's not a condition of underwriting.
Sure.
Credit score, DTI, job, length of employment, cash reserves, all that stuff, which are all factors. Well, here's the thing. Over the last 10 years, the number of people that are self-employed now, or entrepreneurs, continues to go up. The way of the corporate environment, the W-2 borrower, is not nearly as prevalent today as it was 10 years ago. Then you have a bunch of other people that are here in the United States that are allowed to work and pay taxes, which are the international presence, which are the Latinos, Australians, Chinese, Indians, all of them. There's a like come in here to work, and they pay taxes, and they have an international tax ID number, which is an ITIN number, not a social security number, but they can't go down and get the loans from the bank. So that's another void that's just not being capitalized on from the traditional lenders. And honestly, I don't know that it ever will. So all those factors allow for us to write, high quality mortgages to hardworking people that want to have home ownership and not rent. And one of the key pieces on when we do the evaluation is we really like to try to have the rent payment, the cost of ownership from buying the house to be equal to the cost of rent, if possible. So we're not going into these above median home prices in white collar neighborhoods per se. It's more, blue collar. It's more median home price and below, so that we can so they can actually own for fairly similar costs as what it would cost them to rent.
Right.
That's a really a key fundamental for success, in my opinion, because like here's a perfect example. The note portfolio I just bought, I just sold 70 assets, 23 states. The average mortgage payment for P&I was
Which is principal interest for those.
principal and interest, which is all the money that we get.
Right.
Taxes and insurance, we don't get any of that. That goes to the county and insurance companies. The ratio to rent, what I get was over 2.2 to 1 for the whole portfolio. So
Right.
what that means is that if they were paying $500 a month in principal and interest, rent for that property would be $1,100. Okay. So my point is that when we take these notes in, that's a perfect example of ownership versus rent. It's much cheaper in that situation for that borrower to own than it is to rent. Now, I know there's a lot of buy and hold investors out there, and there's a lot of people that look at cash flow and returns. But when you're able to create or buy a note that produces a higher yield than a rental property, it's a beautiful thing, because I'm not dealing with tenants. I'm not dealing with leaky roofs. I mean, you have a mortgage on your house, Scott?
I do. Yep, I do.
And who's it with? It doesn't matter. Just say it's Bank of America.
VIP mortgage, I believe.
All right, BIP.
Yep.
And how long have you owned this? I'm just
Since 2015, I bought this.
So you've owned it about 5 years. Perfect. And how many times have you ever called them for anything?
0 times. Prefer not to talk to them at all.
Yeah. And they prefer not to talk to you as well. Correct? Would you agree on that?
Payment every month. As soon as I stop making the payment, they'll be calling.
They're going to call you, but you're not calling them, right?
Right.
It's a beautiful thing. So as a bank, as a lender, which is what we are, and what you are as a note holder, it's the same thing. I have a mortgage on my home, my primary residence. I've had it 20 years. It's a Bank of America loan. I've never ever called them once. In fact, I don't get phone calls from the people that I wrote notes for now. And if I did, it would go to a servicing company anyway. I never talk to anybody. And that's a beautiful thing, because I'll tell you what, I don't like people that much, to be quite honest with you. And I surely don't want to talking to them about money and getting paid.
Right.
And so that's sort of part of it too. Didn't mean to get off on a tangent, but that's just some of it, because it's a whole different mindset when you're looking at it. And I'm still getting just as much cash flow, and probably even more. Now, the downside is that I don't own the property, right? But do I really care? Because I'm getting amortized payments, right? So when you run an amortization table and I'm charging 10% interest and the house is $100,000, I'm getting $12,000 in year one in principal and interest. And interest only. The principal pay down is a few dollars. It's hardly anything. Another year goes by. Now I just got another $12,000. Now I'm at $24,000 on $100,000. My risk is continuing to go down. If that property value goes up a little bit, I don't get that money, but my ratio or my exposure continues to go down.
Right.
I can take that money, I can reinvest that money, I can go buy notes, I can do all that stuff. So I like the sure thing, as sure of a thing as you can. Now, could they default? Absolutely. Do they default? Sometimes they do. But you know what? Renters move out.
Oh, they do a lot worse.
Yeah, you're lucky. Hope they don't put cement down your toilets. It happens.
That's a real thing. That is a real thing. And that
Absolutely.
really, I mean, this is a great kind of shift, because I want to talk about how somebody that is very transactional in their business, and we've already touched on it a lot, but very transactional, we touched on this before the call, is making, let's say $30,000, $40,000, $50,000 on a flip or on a wholesale deal or whatever. And instead, it's the mindset shift of, okay, well, what happens though if you own the property and become a note holder instead of just making that quick dollar today? So We talked about some of the benefits. With you being a note holder, you're the bank, so you're not responsible for toilets, tenants, trash. Something breaks, any maintenance items, it's not on you. If they don't make their tax payments, it's not on you. You're not responsible for the tax payments. You're not responsible as a note holder for the insurance payments. All you do as a note holder literally is collect checks every single month, right?
Or react to the situation if it goes into a default status, right? And
Correct.
even those taxes and insurance. So we use a third-party servicing company, which basically, and a lot of people that have mortgages are probably making payments to somebody other than what they wrote that note from. So
Right.
a third-party servicing company is basically a third party that is in between the lender and the borrower, and the borrower makes the payment to the servicing company, and then the servicer uh, escrows the taxes and insurance, and they hold it till when it's due, and then the whatever the P&I is, principal and interest, gets sent to your account. Then they also step in the event that the borrower stops paying, makes a late payment. They're getting on the phone, calling them, trying to figure out what's going on. They help facilitate to get them back to a performing status. And if they don't, then as an investor of the bank, just like anything else, sometimes they go down the road to the foreclosure process. Very rarely does that ever happen because there's a lot of things you can do to prevent a foreclosure. You can do deed in lieu, which is given them, give me the cash for keys. You can buy them out. You can do whatever it takes to make it happen. So, but that's all the stuff that we do. So that's easy for me. I'm not really afraid of that stuff because look, I know what if I bought the house right, and let's just take this model for 1 second. Let's do that $100,000 model. 2 years from now, they default, right? And let's say I use my own cash to do this. So I just made $24,000 in interest, right? So now my cost base is, plus I got, probably 15% down. So my cost basis is probably $60,000 on a $100,000 asset. Let's just say that the property value didn't go up and it's still $100,000. So if I only owed $60,000 at a time and the property is worth $100,000, do you think it's that difficult for me to do something with that property, even in the event that I had to foreclose on it? Because all I'm going to do is go do the same thing over again. Right. I'm going to go find another buyer. It gives me 10% down. I'm going to start the process all over again. I don't care. I don't want anybody to lose their house. Most of the time, it doesn't happen that way because there's an equity position the borrower has between the down payment and the sale price. But that's just it. So that's not of any concern to me whatsoever. But it has to be a concern to some people, is whether you're buying a note or you're creating a note. You have to be aware that there's a situation. Nothing's guaranteed, and you want to make sure that you know what the remedy is for any issue that comes about.
So, and I mean, it's an exciting thing because there's not, like I said, you just sit back and collect checks. You don't have to deal with all the problems you deal with on a typical rental property and all the headaches that you deal with as well. But let me shift it to the other side. Why does somebody not want to be a lender? Why would somebody not want to be a note holder? What's wrong with it? Give me something wrong with it.
I think the best answer I can give you the best answer I can say, well, there's two things. One, I don't really watch a lot of television, at least not television for that's not from an educational standpoint. But how many shows are on HGTV, and how many times have you ever seen,
Flip or Flop,
anybody on Flip or Flop, or any of these people ever talking about, hey, why don't you just go carry back the paper and make a 10% note for the next 30 years, and the yield is 16%. You never see it. There's no shows on that. There's nobody ever talks about it. I mean, there's very few people even in the space that talk about the creative financing side of it, on how to be the bank and how to profit from being the bank. That's probably the first thing. I go back to what I said in the first 5 minutes. You don't know what you don't know. A lot of people don't even know they have the ability to bank. Let me tell you something. The IRA, the money allowed that's available. A lot of people don't know they can even go do this in their IRAs. The IRA, 401k and self-directed IRA is about $18 trillion.
Right.
Of that money that's out there, $18 trillion is like a lot of money. There's people that are sitting on, what did the market do this past week, right? I mean, how much volatility is there? How much volatility do you think I have in holding a note?
Yeah, zero, because they're gonna. I mean, you keep making your payments as a borrower, right? You have
Do I care as a lender if the property goes up or down in value?
no,
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 I don't care.
no.
I don't. Doesn't. I only care if they go into default. They're going to still make the payment, the same monthly payment every single month. So that's, the first thing is just they just don't. People don't know they can do it. On the IRA side, a lot of people don't know they can use their self-directed IRAs and Roth IRAs to invest in just this thing. We do it all the time. That's the whole reason why we create the notes, and we use private money from IRA sources to be able to fund on the short term. If they want short term, guess who gets to be the lender on the $75,000 transaction I'm going to go build is the lender. They can be it on the short term. If they want a 6, 7, 8% return long term that's secured by the asset that's worth $100,000, that's available too. So that there's that aspect of it as well. And the third thing is this: it's just more complex. It's just more complex. It's more difficult. Where, just to put it into an analogy, whereas wholesaling might be, algebra, and fix and flipping might be pre-calculus. Creating a note is, finite math
Trick
and
is trick problems.
yeah, yeah, exactly. It's just different, and just most people don't have the, um, um, it's not that they can't do it. It's just not as easy because it's just not as much information out there about it. That's why we sort of do what we do. Um, we don't, you know, I don't do a lot of podcasts. I don't want to do a lot of stuff from the stage, although I have, and I get asked and I do it several times. It's really, really difficult, even in this conversation we're having right here, to really articulate and explain the creative aspect of the deal structure. All I can say is that it can be done. It can be extremely profitable. And it's no different when you're the bank. It's exactly the same thing that all those guys are doing, and they're doing it for a reason. And it's all about money, period, and
And
control.
cash flow, right? You
Yeah, it's
know,
control.
the what would we say, the devil's in the details, or it's always about the fine print, or it's always about what others are willing to not do. Typically is where the money is made, really.
Absolutely. That's an
There's
absolutely. Look, we used to fix all these properties. We still do today. Uh, the stuff that we put into the marketplace, we're extremely proud of. But you don't have to go fix anything. You can go. There's a lot of people that would kill to have a home instead of rent, and will finance it as is, and they'll do all the sweat equity. They'll take their money after they buy it and go fix the kitchen, or remodel the bathroom, or put new flooring in, or whatever that might look like. So you don't have to make this, you know, even as good as rental ready. Although most of our stuff is above rental grade, only because the reason being is because our plan is to hold these notes for a long time. Just like if you're going to do a buy and hold property, you're not going to just like put a tenant in right away. You're going to make sure all of the big 5 items are fixing and working and functioning properly, because you don't want to mess around with that 6 months down the road. Same thing on the note. Even though we don't own that property, we do control it. And if we ever take it back, we want to make sure that it's in the best possible condition as possible.
So to kind of sum up everything that's happened on the call today for the listeners out there, just that maybe tuned in here at the last minute or whatever it might be, we're talking about notes and the power of notes, and how the transactional business that a lot of investors are in, whether that's wholesaling houses, fix and flip, even if you're a landlord and you own a ton of rental properties, the difference between that and what buying and selling notes or being in the note businesses is not only do you get the transactional money up front today, but you also get it long term down the road. Not only that, but you also don't have to deal with the toilets, the tenants, the trash. You don't have to pay for your management company fee every month. You don't have to deal with any repairs that rental property is going to go on. You don't have to deal with any of that. There's a reason why the biggest buildings in any city are the banks. The banks don't own any real estate. They just control the real estate. They control it by a piece of a note that is secured by the real estate. And so that is the biggest fundamental mental shift that I think every investor out there needs to start looking at this. If you're not in the note buying business, or in the note business at all, or even know anything about notes, that's okay. there's a lot of resources out there that can help you get there. One of them right here is Nick, the note guy, and myself. I mean, I'm actively every single day trying to learn and get better at this myself to add this and bolt it on to my already flourishing business. But it's something that's really, really exciting, and I think that we're going to see a lot more of this as time continues to go on. Not just that, but I think that Nick, you talked about another point that's really important for a lot of the listeners to realize is that you're helping families that could not otherwise find financing in other places get into home ownership by writing a note for them, right? That's a big piece. Somebody that maybe you're self-employed, maybe, for whatever reason you can't go to a traditional bank to get a loan. Maybe you're not from this country, whatever it might be. You want to own a home and you can't. Now you've given them an opportunity to do so, and that's huge, man.
So here's something, and I get asked this question all the time because no one believes me when I tell them this. It's economics 101, Scott. And if you go down and when you're dealing with a traditional buyer, okay, a retail buyer, and you have all the signs in the yards and all the different streets, and we're in a very much a seller market right now, right? Sellers controlling the hammer as we speak, not the other way around, right? But that will definitely change at some point in time. So, but that's beside the point. You have multiple houses for sale in the same area, and you're competing with not only the other neighbors for that same one buyer, and then you're also having to deal with the banks and the underwriting to get them approved and so forth. So it's extremely, extremely difficult. And it's like, who's going to blink first, right? Because then the buyers can have some control over because, I got an offer on this guy, he's willing to take $10,000 less and give me all these sellers concessions. Guess what? Guess what happens when you're the bank and you're the seller financing? I don't have any problem because let me tell you something right now. The number of people that need seller financing to buy a house and the number of properties that are available to go buy, not even a fair fight. It's the demand is 1,000 to 1. It's probably even higher than that. So I'm controlling the hammer because I'm going to dictate the term, I'm going to dictate the price, and I'm going to dictate who the buyer is based on the underwriting is. So those are huge, huge factors on their ability to get in and get out of the transactions. So, that's a big part of what we do.
It's kind of inverse of what it is right now in the real estate market, especially here in Phoenix, Arizona, where it's heavily, like you said, controlled by the sellers. It's the sellers market. They're controlling the hammer, right? You're saying in this seller finance world, it's actually reversed. You as the seller financier control
in a hot economy. Can you imagine what it's going to go to when it goes the other direction? Because I'm just going to be able to buy. I mean, I'm not going to have any competition at all.
Right.
Because there's just way too many buyers. So two interesting facts. I'm going to start with a stat analytical guy. I don't have the 2019 number, but in 2018, I'll give you three critical facts that are important to me. 2018, the average declined credit score for traditional loans through traditional financing was between 705 and 710. Declined. It's a pretty high number.
Pretty high number.
I'm going to tell you, right, my credit score is not even 705 because I use my credit. That's beside the point. But 705 is a high number. Number two, the number is it's in the mid to high 40s now of applications of people that in the United States that can't even go get a traditional loan because of the reasons that we talked about, the DTI, credit score, financing. That's the second one. And third thing is, we're talking about seller financing here and just the creative financing and just the number. I think I already told you this number, but I'll pretend like I didn't. In 2018, because 19 numbers aren't out yet, the amount of financing that was done on seller financing term, non-traditional bank for homes, just like we're talking about, was $24 billion. $24 billion
right?
In the United States.
Okay.
That's non-traditional money. That's people, mom and pops, and individuals that have gone out and seller financed their house, did creative financing of some type, stuff that wasn't gone through your traditional loan. That's a big number. So that tells me over the last 4 years, there's over $100 billion of notes that have been written out there of people that are just writing notes because people can't go out to the bank and get the note more than likely. Either the property doesn't meet the conditions of an appraiser to go out and do it, or they just don't meet the terms. So that's a huge number, man. I mean, there's no reason not to have a piece of that action.
Absolutely, and have a massive piece of that action, Nick. I mean, this has been very educational. I think for the listeners out there that are thinking about one, either how can they change their business, and this is another big piece. I'm going to speak specifically to the Phoenix, Arizona market. It's becoming harder to find off-market deals, harder to find wholesale deals, harder to find fix and flips that make sense. And so maybe this is a new approach for you, the listener out there that's listening to this, that's searching for a different mindset to go after real estate deals, right? This is a big shift. I mean, you're already talking about the amount of money that was created in seller finance notes over these last 4 years. This is not going away. And it's an exciting time.
Definitely not going away.
Definitely not going away.
Definitely not. Because what's going to happen when the market conditions change, even less people are going to be able to go get traditional financing. Right. So it's only going to become a bigger opportunity. And that's really what we're really gearing towards. Because you mentioned the wholesaler guy, and you mentioned how difficult it is. I mean, there's such a huge opportunity to go after stuff that's either to get seller financing from the seller themselves. I think we talked about it earlier. 35% of all properties are owned free and clear. Negotiate a higher sales price with those sellers and get favorable terms, and then go and create the seller financing via wrap or on that side as well. Or go buy, you can go buy stuff subject to the existing lien, not assumption, but buy it to the existing Chase or Fargo loan and, wrap that mortgage. I mean, that's what we do, and I don't want to talk too much about it because we're almost out of time. But at the end of the day, it allows you to capitalize on another vertical that you're not capitalizing on from a monetary standpoint. That's a lot of money there. I think the problem that most people have, they're looking for the home runs, Scott. They're looking for the big paydays. They're looking for all the the big time, the big checks because it makes you feel good.
Instant
I'm
money.
telling you what, there's a lot of nickels, dimes, and quarters laying on the ground that people are just walking past. And if you picked all that stuff up, it'd be 100 times more money than all the deals that you do on looking for the big dollars.
Let's do one last thing, which is one last thing to touch on is the taxes, right? So because you're talking about it, if you get a big $50,000 check today, guess who's paying taxes on that? You're paying taxes. But if you take that same amount of money and you spread it out over time, and instead you take installments of it every single month for 10, 15, 20, 30 years, right?
Sure.
Your tax that you're having to pay as the investor, I mean, is minimal compared, right? So your effective tax bracket really could go down considerably, and you can just have passive cash flow. So that's, these are the reasons why I'm excited about it. I know that's why you're excited about it, and that's
Absolutely.
why we have you on the show today so that we can share this to the listeners and make sure that they're aware of it as well. For sake of time here, are you ready for a last lightning round?
Let's do it.
All right, man, let's get after it. So first question, I mean, how important do you feel like mindset is on the success for you in this business?
Well, I think it's the key because you're sort of out on an island by yourself, right? I mean, most people that are solopreneurs in the real estate space, not many people are parts of large organizations that do this. I mean, there's some out there that are with hedge funds, but for all intents and purposes, 99% of the people, they do everything. They're finding the deals, they're fixing them, they're managing the crews, they're managing it all themselves. So it's a very, very, mindset is very important. That's why I also think the educational piece, by being around like-minded people, is a huge, huge piece of the learning and the development piece of this.
Speaking of learning and development, what is the last book that you read, or are you currently reading?
Oh man, which one to pick? Well, the one book that let me say it a little different. I think the one book that had the most impact on us when we were starting out, because we wanted to build a business to sell, not so we built our business to sell. Whether we intended to sell or not wasn't it, because when you build a business to sell, you develop best business practices, you learn how to leverage, you learn how to take advantage of other people's time, money, energy, efforts. And so the one book that we did that was one of my best books was Behemoth by Michael Gerber. Pretty dry read,
Even.
but it's very similar to like Attraction, right? It just was a good book, and I think it just it talks about working on the business versus working in the business, and that's where the mindset comes from. And it's so people have to realize that if you're gonna there's nothing wrong with doing this model, the real estate model, if you want to make $100,000-$200,000 a year. But if you really want to grow that beyond that point, then you need to really be able to figure out how to work outside the box. And the mindset's a critical component of that.
And this is outside the box. Creative finance, learning about
No question.
selling notes, it absolutely is out of the box.
If it was easy, everybody would do it.
Well, and that's exactly it, right? Everybody has the opportunity to do this, right? Everybody can go out there and learn. I can tell you there are lots of resources that tell you exactly how to do it, but the people that actually are doing it is a whole different story. Now, kind of on the subject, but what are you trying to learn? Is there something else about creative finance or about this buying and selling notes that you're trying to learn right now?
Well, I learned something. I learned something new almost every time I go into another real estate meeting or whatnot. I like what we talked about earlier. I've written over 600 notes, and it wasn't until recently that I was able to really figure out. I'm doing first liens, second liens, and I'm starting to parcel out the first liens, and then I'm taking the cash flow and I'm going buying more notes, right? So there's just another layer upon a layer that you can actually continue to build it, even just like roll it and keep rolling with it. It's a crazy, crazy model, and it's all because of amortization. And once you understand the value of amortization, you're going to go, I don't know how the banks can get away with this. Honestly, it's almost like how the hell can you charge and get all your money up front? It's not simple interest, folks. It's a crazy, crazy game, but it's totally legal and it's what they do.
Right.
So we're going to do the same.
And that's the best part, right? So it's all legal, it's all it's ethical, it's legal, and it's continuing to evolve. You can keep adding different layers and you can just keep slicing the same pie in a different way to make more money for yourself. Also, be a good qualified person to help somebody else out time and time and time again, right? So that's super exciting.
All right, back to the lightning round because this is pretty slow here.
Right. What is your superpower?
I don't know that I have one, but I think the one thing that I do best is I have the ability to see deals that aren't really there. I can figure out how to make money on a negative equity deal. Just that simple. I mean, it could be worth $100,000 and the guy could ask $105,000 and I know how to make money off that deal. So I don't know, superpower. I can't fly. I'm fat and slow, so I can't run either. But other than that, that's all you get.
Well, how can the listeners find you? If they want to learn more about you, what you're doing, be involved with Nick, the note guy here.
Yeah, sure. Well, you can go to usanotepro.com. You'll probably post something up there. usanotepro.com. It's a little bit more of a higher level overview. It has there's email addresses on there. There's some downloads and stuff there. We don't really do JV deals because there's just a lot of legal stuff in it. But, if there's a deal that needs some help with it, we can surely look at it because we're always looking to buy and we're always, looking to help people create, especially if it's going to be something they're going to look to sell on the back end. And then we also have a nationwide lending website for those people that are having difficulty finding funds available. A lot of lenders are very, very, very specific on what they want. So that is easybuttonlending.com. It's pretty self-explanatory. There's a bunch of stuff on there too. So if we can help on the lending side, that's great. If you need any help on the notes, or if you have notes that you're looking to get lump sum cash for, we can surely look at that too. So usanotepro.com and easybuttonlending.com.
We'll make sure to add that into the show notes. Nick, I appreciate you being here today. We shared a lot of information. I want to tell the listeners as well, if you got value from this podcast and value from any other podcast, you made it all the way to the end. So I know that you're very interested and you're very intrigued by this, but make sure to click the like button, share it to your friends, tell everybody, because that's how we get our message out there.
Yeah.
Also, you know, in conjunction with what Nick's telling you, go to usanotepro.com and easybuttonlending.com, or reach out to me directly, and I can connect you with whoever you need to help you get involved in notes. And if you have any questions,
And there's
always.
some downloads on there too. There's some ebooks and some other
Yep,
information that'll be of value, both on the lending and the note side. And happy to send a request, and we're happy to send that out to anybody that's looking for more information.
phenomenal. So good, man. Well, thanks again, Nick. Appreciate you being here. We'll talk to you real soon.
All right, buddy. We'll get another deal. Take care,
Okay.
guys.
Talk to you.
All right.
Bye bye.